Wall Street thinks the ultimate constraint on the AI boom is a microchip produced by NVIDIA. But is this actually the case? The true crisis isn't unfolding in the semiconductor sector. It is a crisis hidden deep within the South American open pit copper mines and within the high voltage electrical substation inventory. This is completely backlogged until at least 2031. A massive systemic collision is quietly taking place between our ambitions in the digital space and our physical limits. And if you own generic index funds, you are directly exposed to a commodity supply shock that the market has fundamentally mispriced. Everyone is obsessing over the tech sector's revenue guidance, but almost nobody is considering the load being placed on the grid itself. An AI data center cluster draws up to 10 times the power density of a conventional facility. Moving that power from a baseline generator to an array of H100s from NVIDIA requires an absolutely massive fleet of high voltage transformers. Inside every single one of those heavy units sits miles of ultra pure high conductivity copper wire. And we are desperately in need of a grid expansion of historic proportions, just as global primary copper supply enters its structural decay phase. Conventional financial outlets will tell you to just buy a generic copper mining ETF, blind sector allocation. But the true macro anomaly isn't just rising commodity price, it's a deep divergence in market signaling. Look at this historical demand table. Copper consumption has marched steadily upward for the last 2 decades. Yet right now, the global gold to copper ratio has skyrocketed to an astonishing 50-year high of 1,300 to 1, a level even higher than the 2008 financial crisis. The paper markets are pricing in extreme industrial fear and economic recession, while the physical reality on the ground are shouting that we are completely going to run out of this physical metal. As we move through June 2026, the institutional clock is ticking down. Trillion-dollar AI tech giants have finalized their infrastructure capex budgets, assuming power grids will be able to seamlessly expand. But lead times for critical large power transformers have surged violently from 12 months to over 4 years. The entities caught up in this structural shift aren't just the tech giants, but also any sovereign utility public grid or any global commodity desk. They're realizing the math of this energy transition does not compute. Let's look at the raw engineering driving this macro trade right now. A single 1 gigawatt AI data center factory doesn't just need chips. It requires roughly 50,000 metric tons of copper to satisfy its internal and external power demands. What are these internal coils? This isn't raw unrefined copper ore. It's ultra purified, specialized wire. The capital expenditure of these tech companies is directly bound to this physical footprint. Look closely as we approach 2030. The combined demand from AI data centers and global grid expansion is accelerating towards an astronomical 8 million metric tons of copper every single year. That means electricity infrastructure alone will soon swallow more than a quarter of the entire global copper market. Mainstream analysts assume this demand will easily find supply, but the physical reality of the primary extraction says otherwise. This final chart reveals the core structural trap. The world's largest operating copper mines are entering their twilight years. Average mine ore grades have aggressively collapsed by over 40% in the last 20 years. Miners are forced to blast, haul, process twice the amount of rock to get the same amount of ore as they did than just 20 years ago. That's why primary global mine production is on track to plateau. This is going to be permanently at 33 million metric tons by 2030, right when the AI grid demand curve goes absolutely vertical. Now let's look at what the institutional players are completely blind to. In a normal commodity cycle, When vital resources face a severe supply deficit, prices will rise, margins will contract, and consumers typically pull back on spending. This rebalances the market. But that math doesn't work anymore. And this is because the core buyers driving this economic activity don't operate under the same limitations. Big tech is sitting on an ungodly amount of cash, and they are facing an existential pressure to scale their AI models before their rivals do. Look at this structural projection for the gold to copper ratio. On paper, the ratio is near an extreme level because gold has surged as a defensive safe haven, while copper looks completely stuck at the same price as just 5 years ago. But behind this paper pricing sits a brutal corporate squeeze. Copper represents less than 0.5% of the total cost of a multi-billion-dollar AI data center project. That means that Google, Microsoft, SpaceX, they're completely price inelastic. They don't care if the copper trades at $4 a pound or $12 a pound. They will pay premium to secure their facility first. This creates a devastating crowding out effect. Your local public grid and utility company, they operate on razor thin margins and they're legally capped. They can't raise prices. They can't outbid a multi-trillion-dollar tech giant to get these components. Big tech isn't just buying copper on the public markets like COMEX. They're bypassing public exchanges entirely, and they're funding forward manufacturing capacity. They're effectively hoarding global transformer supply and locking up high purity wire rod fabricators for the next decade. They are building a private industrial moat to starve out the rest of the global economy from getting these supplies. To capitalize on this severe structural bottleneck, institutional players do not buy regular mining ETFs. Those operations are heavily exposed to national security issues from sovereign countries and tightening water restrictions and labor disputes in Chile and Peru, etc. So, Breaking Markets Playbook shifts the capital to two specific areas. First, position in the dominant midstream precision fabricator and high voltage grid equipment monopolies. Companies like the Eaton Corporation, ticker ETN, and Schneider Electric. They hold multi-year backlogs and have structured their delivery contracts clauses to be indexed, allowing them to pass on copper price spikes directly onto the tech buyers while maintaining their own record high margins. Second, use regulated regional utilities as your primary indicator. The moment municipal power companies begin to formally delay their grid upgrades because they can't get a hold of equipment, you will know that the squeeze for copper is effectively on, and the next ones to be hit will be the tech giants who can't find enough supply for their massive capex budgets. Then finally, there's the sovereign angle. This is where governments start to view domestic electricity not as a public grid or public service, but directly as a national security problem. And they will begin to hoard computing capacity for themselves. This is going to pivot from a massive public grid to accelerating the demand for private power generation, specifically for nuclear energy. The world's largest technology firms are abandoning public grids entirely, choosing instead to direct their finance to private closed-loop nuclear infrastructure. This bypasses the copper-starved municipal networks and goes directly to their bottom line. For our video on uranium and nuclear energy, subscribe and like this video.